Denise Brown at the Leading Edge team up at RE/MAX in Whistler. How are you? I've got Eileen Craig with me here today. She's with Sea to Sky Mortgages, works with us in our office, and we love having her around. Eileen's going to help us explain a number of things today, including the Canadian mortgage system, and then we're going to pop in on first-time home buyers, regular residential property purchases, and some non-resident tips. So I hope you can stick around and join us in the conversation. So, Eileen, you're going to explain firstly some of the uniqueness about Canadian mortgages, because we know in the US, for example, it's quite different, and sometimes we have to sort of explain, how different it is.
Okay, for a mortgage in Canada is 25 years on average. So some Canadians can extend their amortization to 30 years, but if you're a non-resident, maximum amortization is 25 years. One of the other things we don't have here is an interest-only loan. A lot of our non-resident clients are used to having interest-only loans or readvanceable mortgages, and that's not something we're able to offer them here. So, ours are. One of the big things to know about Canadian mortgages is that our mortgages are always closed. So they're not an open mortgage. In the US, for example, you can get out of your mortgage at any time. In Canada, you can't. If you want to get out of your mortgage, you're going to pay a penalty. And that penalty, industry standard, is the greater of 3 months interest or the interest rate differential, which is the difference between the rate you get today on your mortgage and what the bank can lend that money out for at the time you want to get out of the mortgage. Okay. So we want to chat to our clients about what their plans are for their mortgage. A longer term isn't necessarily the mortgage term they want. They'll get a little bit more flexibility with a variable rate mortgage, because that's only ever going to have a 3-month interest penalty.
So the variable rate mortgage then, is that where you're signing up for the terms like 1 year, 3, 5? Is that what you're considering a variable rate?
A variable rate mortgage is a mortgage that the interest rate floats with our prime lending rate in Canada. So it's going to go up and down based on what the prime rate is. Our current prime rate in March of 2019 is 3.95. So the rate's going to go up and down depending on what's happening in the market.
The current bank rate is prime rate.
Yeah, the Canadian prime lending rate is
right. So the Canadian prime lending rate is 3.9%. What does that mean?
3.95. That is the lending rate that all banks base their lending on.
So is that the amount that they borrow from the government?
No, it is not. That is the Bank of Canada rate.
That's the Bank of Canada rate.
Yeah, okay. That's a different one. So no, it is our bank prime lending rate. So that's what they'll base their lending off of.
So if I've got a line of credit and I've got a really good relationship with my bank, they might give it to me at the prime rate.
They might. In most cases now, it's prime plus a half or prime plus 1.
I got to talk to my bank, because I think I'm prime plus 3.
Oh, you got to talk to your bank.
I got to talk to my bank. Okay. So, but then the relationship between the Canadian prime bank rate and the mortgage rates are.
Well, the variable rate mortgages work off the prime rate.
I see.
So the fixed rate mortgages are based on the bond rate. So they're a different beast.
Okay.
So the variable rate is a floating rate, and generally we'll see more savvy borrowers look at a variable rate mortgage. It doesn't make sense for everybody.
So have they negotiated a percentage above the Canadian prime bank rate as the rate that they're going to be offered? Yeah.
Generally, it's a discounted prime rate. So right now, for an insured mortgage, so somebody who's putting less than 20% down, they're going to get about prime minus 1%. But the average discounted lending rate on a variable rate mortgage right now is prime minus a half. So prime minus 0.5.
All right. So we've just discussed the amortization period being on average 25 years, and we talked about a variable rate mortgage, how it's attached to the Canadian prime bank rate, which is currently 3.95%. Now there's the normal type of mortgages, which have shorter terms and a fixed rate. So how about we explain that? So US, they don't have that. They just go 30
Yeah,
years or
exactly.
25 years.
And that's a big difference for them, is that our terms are guaranteed, and the interest rate is guaranteed for the time that they take the mortgage. So if you're taking a 1-year mortgage, your interest rate is fixed for 1 year. At the end of that term, you don't necessarily re-qualify for your mortgage. You can renew your mortgage directly with your lender if that's what makes the most sense for you, and then roll it into another locked-in term, maybe another 1 year, maybe a 5-year, depending on what you're doing with your mortgage, what's happening in the market, and what your plans are.
Yeah, so what they're doing is still amortizing out your payment over the 25 years, or what's remaining of the 25 years. It's just that at the end of the term that you first signed up for, like if it's 1 year, at the end of that 1 year, you're going to say, wow, is the interest rate going up? Maybe I lock in at a longer term, which is lower, and then they say, well, the payments based on the remaining 24 years are X.
Yes.
So if you go, well, the interest rates are going up, I'm going to stay at a short term, and then my payments are going to be calculated still based on the 24 years, but
only for 1 year.
But only for 1 year.
Yeah.
So that may not make nonsense sense, but anyway, so the short story. So we have, I'm going to say, contracts or guarantees for 1, 2, 3, 5, and up to 10 years. And then you negotiate with
your lender or your mortgage broker.
Or your mortgage broker who goes to work for you. And they give you the best rate, and you go, okay, I sign up for that for an initial term of 25, although I've had 20 years if you want to keep it shorter.
Yes.
And then that tells you what rate you're going to pay. And then at the end of that term, whether you've said 1 year, 2, 3, or 5, you say, okay, what's the best thing for me to do? I'm going to move next year, maybe I'll do another short term, or I'm going to stay here for the next 5 years, I'm going to do 5 years, and decide and lock in for that 5-year term, and then you can sit comfy because you know how much your payments are going to be for the next 5 years based on the remaining amount of your amortization period.
Yes. The other thing to remember is at the end of your term, your mortgage is completely open. So at that point, you can pay it right off without penalty. So if you want to make a lump sum payment during your mortgage term, every lender will allow you to make a prepayment. Generally anywhere from 10% to 20%, depending on your lender. But at the end of your term, you're free to pay off the whole thing. So if you have an inheritance, you won the lottery, or you really don't like your bank, you can move. You can move your mortgage. You can do anything like that. Yeah. Flexible each time. So you go to your mortgage broker and say, hey, is this the best option right now? Should I stay here, or should I be, making a change? Yes. That's what I think. Yes, and that's definitely something that we let our clients know. If you're sitting at the best rate, we're not going to try and move you somewhere else. Yeah. We're going to give you good advice. Okay. Well, thanks, Eileen. That's a really good start to our little conversation. Okay.